everyone. So I'm Julie Wilkinson and I own Wilkinson Accounting Solutions. We specialise in helping businesses double growth, ambitious directors growing with confidence, credibility and calculated risk. We specialise in growing SMEs and also do mergers and acquisitions. Is everyone business owners here today? So I'm just a bit interested in who we've got. Is anyone under 250k turnover? Anyone looking to grow by acquisition? Yeah. So today I'm going to be talking about how we make good decisions in our business. So ultimately, one of the things we do for businesses is we help them look at how profitable they are and how quickly can they make decisions. So ultimately, I presume everybody has to make decisions in their business. And what we find is, ultimately, as a business owner, every decision you make will have some form of financial consequence, be that time, profit or cash. And we find a lot that people don't have the right data quickly enough to make those decisions. So either they make guesswork because they're not really sure, and ultimately they often make wrong decisions because they'll just look at what they've got today in their bank account. I don't know if anyone does that. So basically we work with people to look at, well, how are they making decisions? Now, a lot of people have a system, whether it be a QuickBooks or a Xero or something like that. How do you actually use that information to make the decisions that you want? So, why do businesses lose money? So we saw, obviously, with COVID, some businesses obviously failed, but lots of businesses have thrived. Ultimately, that's been from making decisions. And I suppose the question post-COVID is now to sit back and think, well, actually, could some of those changes happen before? Because a lot of people make reactive decisions, not really proactive decisions. So actually, if some of these businesses, especially when you look at the delivery firms and that, and restaurants doing deliveries, now they're continuing because it's profitable. And what would have happened if they'd done that before? Would they have had as much impact? So generally, businesses lose money because they don't have, it's not because they can't make decisions, but they don't have the right information to make the decisions. So reasons businesses lose money. So they have lack of business planning. So no vision or goal. So ultimately, it doesn't mean you don't have a vision, but if it's up here and not on paper, you have no way to track against it. We have poor cash flow management. So we're talking about the cash flow forecasting, because if you're using the bank today to make decisions, you can make wrong decisions, because ultimately you can think, oh yeah, I've got loads of money because the customer's just paid you, but you forget, oh, I've got that bill to pay. Or the other way, I'm not going to do something because I don't think I've got enough money. But there are always alternative financing. So we work a lot with brokers, so we do loads of lending, help people get funding, but it doesn't always have to be big lending. You've got interest-free credit cards, drawdown facilities where you only pay when you take the money, overdraft facilities. Sometimes you just need a bit of support along the way. We have complacency, so there's a heavy reliance. So a lot of people might get referrals. I don't know if anyone gets referrals. Problem is, when you get referrals, generally you get the same type of referral. And ultimately, if you have one sort of line of income stream, when something happens, you have more risk of failure, because ultimately you could go overnight. And it's not just small businesses that are impacted. I mean, we look at some businesses in industry, people like Blockbusters, Nokia, Thomas Cook, they've all failed over time. They're all profitable business, but ultimately they have bad cash flow. We have no clear value proposition. So people underprice a lot because they get scared. What we find is where you have what people think are their top value pricing generally earns them the less money, because as they go up, they get scared to actually charge the right amount of money, and they don't know how to analyse, especially doing things like adding your own time value when your quotations is really important, because ultimately that is your time is money. And what you have to think if you're going to scale a business is it might be you now, but if it wasn't you and you was paying someone to do it, would you still make money? So lack of data and analysis. So a lot of people, most people, I don't know, a lot of people don't really understand. Data can seem quite boring, but ultimately it doesn't have to be boring. It's all about, you don't want no one wants hundreds of pages a day because no one ever looks at it. What you actually want is good, timely information, a few bits of your key KPIs that you can analyse. The KPIs are really important, but making them actually related to your business, not just any KPI, is what's really important. And poor financial processes. So, things that are taking time. So I remember a small cafe that we worked with. They had someone, when people were placing orders, they then were printing them orders and putting it in the calendar. So ultimately, you've got a lot more risk because someone's having to duplicate it. You've got the printing costs, and you're paying someone to do something. So actually, they then realised, oh, you could link the booking portal to the calendar. I mean, I think it only costs about £1,000 to implement. Well, ultimately, if you're paying someone, say, £15, £20 an hour, you'll have a saving over a few months. So, how can businesses consistently make more money? So this is the thing, consistently, because we find especially growing businesses suffer more because they try to grow too quickly. They don't have the operational capability or the cash flow to sustain it. So, business planning and forecasting. So mapping out future plans. So it's important when we work with businesses, you know, at the end of the day, the reality is anyone can get a spreadsheet and put on 5%. The fact is, do you trust it? How? So when we work with lenders a lot, they'll be like, it's the trust under like those numbers. And if you know, right, I need X number of customers, X number of order values, I know that my revenue is this. So the most important thing really is to work, well, what do I actually want to achieve in 12 months' time, and work backwards. Making sure it's like reality for you and what you want to do as well out of your business, like what you enjoy. Review what is working and what is not working. So everybody makes mistakes. I've made mistakes. I'm sure we've all made mistakes. Ultimately, as long as you know you're doing it and you change, that is what's important. But you only know it doesn't work if you analyse it. Understand customer types. So we were talking before about knowing who your customer is and not underselling yourself and having multiple income streams, and being really clear who it is, because ultimately, if you're trying to always find the wrong customer and they're not buying your value, you're finding that you're having to sell it too hard or you're underpricing, then it's the wrong type. Define your key objectives. So that could mean, well, I want to grow by 20%, but then how do you do that, and who do you bring into the business? You know, even if you outsource work, you know, if you have a marketing firm, let's just say, and if you don't know what your return on investment is, how do they know what they've got to work towards? You know, do they just spend endless amount of money? I mean, I've worked with people that spend thousands on marketing, and they actually say to me, well, I just don't expect it to work anymore, but they still do it because people get complacent and they don't know how to change. Build financial forecasts in line with the plan. So ultimately, business planning and financial planning are one and the same, but they are different. So business planning would ultimately be, who do I want to work with? What do I offer? What is my USP? Your financial planning is, how will they pay me? Like, how do you get money? Like, are you doing work before you're getting paid? Thinking of sort of cash flow in mind as well when you're setting the business, not just how much you're going to charge, but how they pay you as well. So understand the number of customers required. So this one's really important and quite an easy one to get sometimes when you have the right model, because ultimately, if you want to make X amount of money and you charge X amount of money, then you know this is how many I've got to make. I think what's important for this is being realistic. So ultimately, someone might say, well, I only want to work 4 days a week. But if you're like, okay, well, I want to make 100K, but actually the time it's taking you to serve those customers, the reality is you might not be able to make the plan, which means you have to change. You have to go back to the drawing board and then change what you're going to do, which there's nothing wrong with that. But ultimately, if you don't have the plan in the first place, what generally happens is you might be 6 months in and then realise, whereas actually you could realise right at the beginning. So, and then define your key budgets. So, cash flow planning. So cash flow we talk about a lot. Most businesses that fail will be because of bad cash flow. You can be profitable, but if you haven't got the cash to pay suppliers. And we see a lot, where people are doing work and then don't get paid, like constantly having to chase. And it's important to sort of have a cash flow strategy in mind. So when you build your financial forecast and business planning, you should start thinking about, well, how do you negotiate terms with your suppliers? And ultimately, if something's cheaper to pay up front, if you've got like a 12-month interest-free credit card, then actually you're doing the same thing, but you can pay it off and not have to pay it all up front. Review the investments required. There's nothing wrong with getting investments, but ultimately you have to be prepared and know like what investment you need, and then ultimately, obviously, you have to be able to pay the investment back. think about your upfront costs. So I think a lot of people like delve in and they don't actually think, oh, I might need a system, I might need a VA, I might need an accountant. Like quoting those costs into the plans as you go along is important, because ultimately a lot of people don't like to outsource because they think, oh, I'm spending the money. But actually, you getting your time back should be more valuable than actually paying someone to do something. But if you don't know the cost in the first place, then the problem is you don't know it's in there, and you'll just carry on, and then you'll get too busy, and then you'll get bombarded with work. And having the right team around you, whether that's employed or outsourced, is really important. So build a 12-week rolling forecast. That's why I was asking at the beginning whether anyone would know what they might have in their bank at the end of December. Doesn't have to be anything too complicated. You know the bank balance today. You have ultimately you look at, when am I going to try and get money in? When do I pay money out? And if it doesn't look good, then you have to do something about it, and you have to start making decisions. Well, it doesn't mean, oh, I don't spend that, because ultimately not spending something can hinder you, but you have to think to yourself, well, how can I then manage that to actually afford what I want to do? And that might be then when you need the investments. Make sure your key balance sheets reconcile. So we see this all the time. Ultimately, has everyone got an accountant? How many times a year do you see your accountant? Once. So, and they give you a report and you think, oh, everything's okay because I have the accountants. Well, the reality is, if your balance sheet doesn't reconcile to your trial balance, so when you run the trial balance in Xero or QuickBooks, we've seen, so we got a business that was relatively quite small, a couple of 100k turnover. They had 800 purchase invoices outstanding. They ended up with a 25 grand VAT liability because they had this number on a bit of paper. They thought it was right because they trusted their accountant, but ultimately the accountant doesn't generally reconcile. They just take your numbers and prepare the accounts. So they are needed because you get good tax savings, but they're not financial strategists. They don't help you use that information to grow. It's very backward looking, not forward looking. So making sure everything reconciles, that means the whole balance sheet, sorry, that was a bit loud. That means the whole balance sheet needs to reconcile. And that's one thing that we work with businesses on. We look at like, what's your integrity like on your accounts? So use bill forecast to use longer term plans. So we recommend you would have at least a 12-month forecast in detail, and then a longer term, and then maybe like a 3 to 4 year one high level, just so you can see like what the future looks like in the business. So robust financial processes. I better just check the time. Yes, ma'am. Good, robust allocate. So how do we allocate costs and stocks? So I worked with a business once and they did exhibitions. Now their exhibitions were about £1 million. Now ultimately they didn't know how profitable they were because it was just incorporated within the business model. So if you have lots of things incorporated within one business model. So what we did was we said, right, what we're going to do is pull it out. So what we took the P&L from whatever the system, I think it was Sage they used, and we split it out and we allocated the number of staff and everything. And what we actually found was out of the 7 exhibitions, 3 made a loss. And they had no idea they made a loss because ultimately the business was profitable. So then it was a bit like, well, they got a bit upset at first, but then we looked at, well, why was it making a loss? So what we did, so when they sold the exhibitions, we got a little table and we said, right, if you could sell all of your tables for maximum value, what could you have earned? And then we looked at what did you learn. The reality was they lost 150 grand in a year purely because the person selling the table was just going back to the same person and just giving discount after discount every year, and they didn't even know, but no one was intentionally doing it. But it all comes down to data and actually how is someone tracked. So then they said to that employee, well now you have to sign off if you want to give more than a difficult discount. So we found about 7 of these things, and for £1 million we put £500,000 on the bottom line in 1 year forecast just by changing about 5 things. But some of them are really simple things. They just didn't know because it was all just incorporated into one number. So timely and accurate reconciliations, and then automation. So we see a lot. One of the things we do is help like get a quick month end. So we went into a business that had like 25-day month end. I mean, ultimately, it doesn't really help because by the time you get to the end of the month and you realise you haven't done, you're starting the next month. So we help people get down to 3-day closes. And the way we do it is if you have the good trading pack with your key KPIs to calculate net margin, like gross profit margin, and your overheads are kind of standard, technically you should know what your profits will be before you even get to month end, which then means you can do a quick close. Oh, it's been good, it's been bad, and make the decisions that you need. We see a lot, especially like P&P in retail, because we work a lot of retail firms. They don't break out P&P margin against P&P gross margin, so it's incorporated. A lot of times people are making losses because they're doing free P&P and they're not really analysing what they're doing. So automation to get real-time information is really important, so you can get accurate information. But I would say to people that systems don't fix bad processes. So if you have a bad bookkeeping process, a system won't change that, because ultimately you'll get bad information out of it. So having accurate information is really important. Debt chasing policies, making sure that people are chasing debt or trying to use things like go cardless and things to get money quicker, get quicker in. Supplier payments, so especially if you have employees, we find a lot of businesses, if they want, especially if they're looking to scale, ultimately if the director is still going into a folder making payments, it's difficult to scale, because how can you step away when you've got the final say? So we look at systems and controls of how can you go for order all the way through to payment and actually not be involved in the process. And that takes a lot of work and a lot of trust. But if you have the right controls, the right segregation of duties and the right systems, you can do it. So credit checks for customers, especially if you're doing stuff on credit, you can use, like we have Credit Safe, we do credit checks for our customers. You can do credit checks to see whether they're viable. And regular cash flow review, so we've already talked about our 12-week cash flows. Realistically, you should be doing 12-week cash flows, but then comparing those cash flows against the forecast, because ultimately if you're always off, you need to understand why. Trend analysis, so trends are really important. You basically build future planning on past trends, because you use what you've done historically, what's worked well, what hasn't worked well, to then implement the future with continuous analysis. But the problem is if you only do it once a year, then you don't, it's not enough time. You make bad decisions and you're already further down the line. So diversification. So build a diversity. We would always say never have more than 20% of income coming from one type of customer. We actually saw it a lot in the accountant world, where people were doing like consultancy, tax returns because they were easy. And then when IR35 came in, people lost 80% of their business overnight, because ultimately they had one type of customer. And it doesn't need to be something as drastic as COVID. Things change all the time. Customer demands change, competitors come in, everything changes, and you have to be complete diversification all the time to like manage that. So think of key risks to your business and how you can mitigate it. So think about like what happens if people don't pay you. I don't know, what happens if customers go under. Just thinking about key risks. So most people do like a risk matrix. We do it a lot, especially on our mergers and acquisitions. We do a lot of mergers and acquisitions. And we help people like as business advisors, like looking at like what's the risk. Because ultimately if you buy a business and that you don't want to run the business and the owner's going to leave, just things as simple as like, well, what's the quoting process? Like how does someone quote? If it's all up here and they're going to step away, you've automatically got a risk. So clear value propositions. So really understanding your customer. I mean, I'm not a marketing expert, but actually it does fall in line with it a little bit, because when you get these marketing firms that go, well, we can market for you, ultimately, if you haven't done your pricing strategy first, how do you know the right customer? Because yes, you do need to know where they hang out, you do need to know who they are, but actually, if you are going to the wrong customer type with the wrong pricing, then actually maybe you're looking at the wrong profile. So I find it strange when marketing firms will just use someone when they haven't got a pricing strategy, because I don't really understand how they can know it's the right person, the right strategy. So, analyse data. So, for me, we will always look at financial and non-financial. Like, yes, you do need to know sales, you do need to know margins. But I remember I like to do scenarios. So we were with someone and they did call centres, and they always said, oh, they had loads of agents. They had this management accounts, and they had this, I don't know, it was something like £1,000 a month for like a budget for a buffer for overtime. And in the management accounts, it was always, they spent the 1,000. But the question is, well, why do you have the 1,000? Oh, well, when it's buy one get one free, the calls spike. So anyway, we looked into it. We built 3 graphs, and the reality was that they didn't perform in the evening. So they did 2-minute talk times in the day, 8-minute talk times in the evening. So they went back to them and said, you're now being managed 24 hours a day. And they said they cut something like 7 heads, and they said about 400 grand in a year just from free drafts. So obviously, that scale is big, but it's the same principle regardless of the size of the business. I'll just check the time. So types of useful data that you can analyse. So we have budgeting. So budgeting would be you forecasting what you want to happen, because ultimately that's going to become your plan. But realistically, the budget's only useful for at least 1 quarter, because once you get actual information and it changes, you have to over-type the budget with the new and be realistic about the new budget. You have management accounts and variance analysis, so that's ultimately you then analysing your profit and loss against your budget. But doing that is harder said than done, because the sales number might be easy, but actually, if let's just say you're a retail firm and your sales are down 20%, why are they down? Is it less customers? Is it less mix? Have you done free P&P or free products? And actually, where do free products come in? Is that a form of marketing spend? Or, and if you have a marketing spend on top, do you even think about, when I give free P&P as a marketing, because that actually sits in a different part of the P&L, so you probably wouldn't even notice it. Working capital and cash flow, so there's loads of working capital ratios you can do. Standard ones are like debtor days and creditor days. So ultimately, the reality is if you're paying creditors on 30 days and getting paid on 45 days, you've got a relatively poor working capital, because you would actually want cash to come in before you pay them as much as you can. Number of repeat customers, return on investments. I mean, I use an outsourced marketing firm, but we have key KPIs, we have key objectives, and they report back on like a spreadsheet, just like simple, this is the conversion rates, etc. Competitor trends, so look at what the competitors are doing. We do a lot of industry analysis, like gearing ratios, like how highly geared are you, and looking at your industry and what helps you when you want to go and get funding and things like that. Profitability, like a customer or product level. So that's either a service, customer or product profitability, depending on what you're in. Because ultimately, going back to that exhibition analysis, you don't really see it on a standard P&L. You'd have to get down to the detail to actually know it. So, key takeaways. Definitely have good bookkeeping processes, because systems don't fix bad processes. So if you have a poor bookkeeping process, then actually the data won't mean anything. And if anything, it will be worse, because you'll now be making bad decisions of incorrect information. So it has to be good information, realistic and timely. You want at least a 12-week forecast, which you update each week, and then compare against the next week, just to see, why am I on target or why am I not on target? Make sure you have 3 measurable KPIs. So KPIs are sort of like objectives in the business. So think about, so it could be, right, I want to have a 20% customer increase, and then scaling that down to how you might get there. Like, what does that mean? Do you need staff to do it? What stock management do you need? Like, what do you need to do with your services to get there? Review your pricing structures, what you're charging people. Look at your customer mix to see, are there opportunities to upsell, JVs with people, commission-based referrals. So that's me. So we help people. So this little graph here, I just always say to people, what would it make to you if you can make decisions like this? But ultimately, this is what you can get. This will come from your accounting system. The accounting system, let's face it, is boring, right? But these types of things is what you need from that information. So yeah, make decisions.